Most people think working after retirement is simple. Collect your Social Security and pick up a paycheck. But in 2026, the new earnings limits can cost you thousands if you miss a single detail. Do you know if your side job could suspend your benefit, or exactly which dollars push you over the line? Here is what you need to know before your next payday. The Social Security earnings limit is not a blanket rule for every program or every retiree. It applies exclusively to people collecting Social Security retirement benefits before they reach full retirement age. Supplemental Security Income, or SSI, follows a completely different set of income rules. Social Security Disability Insurance, known as SSDI, has its own separate work test. For anyone receiving retirement benefits, understanding where you fall on the age ladder is essential. Full retirement age, often called FRA, is not a single number for everyone. It depends on your birth year. If you were born in 1954 or earlier, full retirement age is 66. For people born from 1955 to 1959, full retirement age increases in 2-month steps. For example, if you were born in 1955, full retirement age is 66 and 2 months. If you were born in 1956, it is 66 and 4 months. If you were born in 1960 or later, your full retirement age is 67. This date matters because the earnings limit disappears once you hit your own full retirement age. At that point, you can work as much as you want, earn any amount, and there will be no reduction to your Social Security check. The only period these earnings limits can affect your benefit is before you reach that milestone. Knowing your exact FRA is the first step in figuring out whether the earnings limit applies to you at all and when it will stop affecting your benefits for good. For many people, that means checking the Social Security Administration chart or using their online calculators to find your precise cutoff. Once you know your FRA, you can see exactly how long you will need to pay attention to these rules and when you will be free of them for good. 2 numbers define the Social Security earnings test for 2026. The first is $24,480. This annual cap applies to anyone collecting retirement benefits before the calendar year they reach full retirement age. If your work income stays at or below this threshold, your Social Security check continues in full. But every dollar earned above the $24,480 limit triggers a straightforward penalty. Social Security withholds $1 in benefits for every $2 you go over the limit. For example, earning $28,480 means $4,000 over the cap. So $2,000 are withheld from your benefits for the year. The second number comes into play during the year you reach your full retirement age. The cap jumps to $65,160 for 2026, nearly triple the standard limit. The penalty formula also shifts. Social Security now withholds $1 for every $3 you earn above $65,160, but only for earnings before the month you reach full retirement age. If you earn $70,160 before that month, you are $5,000 over, so $1,666 is withheld from your benefits. Once you hit that birthday month, all limits disappear, and you can earn any amount without further reduction. These formulas allow a quick estimate of how much benefit might be withheld. The $24,480 cap and the $65,160 cap, paired with the $1 for every $2 rule and the $1 for every $3 rule, make it possible to do the math in seconds. Knowing these numbers is the first step to planning work and Social Security together in 2026. Social Security's earnings test draws a bright line between what counts as income and what does not. The rule is personal, measuring your own work income, not your household's. If you are married, your spouse's paycheck or business earnings have no bearing on your Social Security check unless they are collecting benefits from your work record. The system does not add up your household wages, nor does it look at joint tax returns for this purpose. Each person's earnings are tested separately, so your neighbor's job, your spouse's consulting gig, or your adult child's side hustle all stay out of your Social Security calculations. What matters is the money you earn from active work, your gross wages if you are an employee, or your net self-employment income if you run your own business. Social Security uses the figure before taxes for employees and after business expenses for the self-employed. It is not just about the amount, but about the nature of the income. Only paychecks and business profits count. If you pick up a part-time job, freelance, or drive for a rideshare company, those dollars go straight into the earnings test. But if you are living on a pension, drawing from an IRA, collecting dividends, or selling investments, those funds are invisible to Social Security's limit. This distinction is powerful. A retiree could have a six-figure income from investments, annuities, or retirement accounts and still receive full Social Security benefits as long as they are not working for a paycheck. The earnings test is designed to measure ongoing participation in the workforce, not your total financial picture. Knowing exactly which dollars count means you can structure your retirement income without fear of unexpected benefit reductions. When a retiree earns more than the Social Security limit, the impact is felt right away in their monthly cash flow. The Social Security Administration does not spread out the withholding over the year or make partial deductions from each check. Instead, the agency suspends entire monthly payments until the amount owed is covered. Take a retiree with a $2,100 monthly benefit who earns $9,000 above the annual limit. Social Security calculates the excess and withholds $1 for every $2 earned over the limit, totaling $4,500 withheld. Since partial months are not an option, the Social Security Administration rounds up and withholds 3 full monthly checks, which comes to $6,300. That means no payment for January, February, or March. The checks resume in April, and if too much was withheld, the difference is paid back later. For someone relying on steady income, this creates a noticeable gap. The process is automatic, and the suspension takes effect quickly, leaving a retiree to bridge the missing months until payments resume. At full retirement age, Social Security takes a second look at your record and restores value for any months your benefits were withheld because you earned too much. This process is called the Adjustment to the Reduction Factor, ARF. The ARF recalculates your permanent benefit, adding back a portion for every month you did not actually receive a payment. The math is straightforward. For each month benefits were suspended, about 0.5% is credited back to your ongoing check. So, if you had 8 months withheld over the years, your benefit at full retirement age goes up by roughly 4%. This adjustment happens automatically. You do not need to file a special request or any paperwork. The purpose is to ensure that your early filing reduction only applies to months you actually collected Social Security, not months you missed because of the earnings limit. Over a long retirement, this restoration adds up, providing a real boost to your future income and reassuring anyone worried that withheld benefits are lost for good. Reporting your expected earnings to Social Security is not just a formality. It is your best protection against a financial headache years down the road. The agency's system runs on annual wage reports from the IRS and from employers, but their reconciliation can lag by 4 or 5 years. That means a retiree who quietly exceeds the limit in 2026 could get a letter in 2030 demanding thousands of dollars in repayment long after the money has been spent. Filing a work report up front puts you in control. Benefits are withheld right away, but you avoid the shock and stress of a surprise overpayment bill. For those retiring mid-year, the grace year rule offers relief. If your monthly earnings drop below $2,040 or below $5,430 if you reach full retirement age in 2026, benefits are paid for those months even if your total annual income is high. The monthly rule lets people start collecting benefits mid-year without an automatic penalty for post-retirement months. But the impact of excess earnings does not stop with your own check. Any spouse or child drawing benefits based on your work record will see their payments suspended as well. Only ex-spouses remain shielded. Their benefit continues no matter how much you earn. Bottom line, report your expected earnings to avoid late overpayment demands. Understand the grace year monthly limits if you retire mid-year, and remember that excess earnings can affect dependent benefits paid from your record. Be proactive and work with Social Security to keep control of your retirement income and your family's benefits. Every year, over 2 million Americans face Social Security adjustments tied to their work. In 2026, understanding these rules is not just smart, it is essential for your financial future. Retirement is not static, and neither are the rules. The choices you make now can echo for decades, affecting your income and your planning. Subscribe for updates on Social Security changes and download the free retirement guide for strategies on sequence of returns, risk and portfolio management. Thank you for watching.